Hello, everyone. I'm recording the online review session for homework 1. I'm going to go through each questions. So homework 1, question 1, the material wealth of society is determined by the economy's what? And what is a function of the economy's? So I think this question is related to the concept of real asset and financial asset. So the wealth is determined by the economy's productive capacity, and which is a function of the economy's real asset. So D. I think we can easily exclude and eliminate A and B because it's the wealth of the society is nowhere being determined by investment bankers. So A and B can be eliminated. And the second, and then moving on, if you look at C, when the wealth of the society is determined by productive capacity, this is not a function of financial asset because how productive is the firm, the worker, and the factory is determined by the real asset. And of course, real assets including human capital as well. And move on to second question. What assets generate net income to the economy and what assets define allocation of income among investors? So I think when you touch on the allocation of income, so we're talking about how to claim the return of a real asset. So that will be financial, the determination of financial assets that each individual owns, and that represents their ownership for the income and for the profitability. So second one will be financial assets. So that will leave us A and C. And what asset will actually generate income to the economy? And that will be real asset. So C. 3. What are the examples of financial intermediaries? Financial intermediaries are basically financial firms. So they serve as the middleman that try to match suppliers with the whoever wants to demand capital. So the group of people that can provide capital are usually household, and the group of organizations that require capitals are usually companies. And banks and financial companies serve as intermediaries that match the borrower with the lender. So that includes commercial banks, includes insurance company, includes investment company. So all of them are financial intermediaries. So they provide financial services. 4, asset allocation refers to asset allocation is a specific term. So it's well defined in finance that it is a decisions about allocating assets between asset classes. So it will be the allocation of investment portfolio across broad asset classes. So it's not going to be analysis of the value of securities, that is called security analysis. And the choice of specific assets within each asset class is called security selection. Okay, 5, what is a mechanism for mitigating potential agency problem? So we're going to talk about mitigating agency problem. It's not about causing agency problem. We're trying to find corporate governance tools or methods that can help to make sure that managers are doing their jobs and maximize the shareholder profit. So tying income of managers to the success of the firm, that is right. That is a good, basically looking at the compensations of the manager. Directors defending top management. We want directors to monitor top management, not necessarily defend. If they defend the top management, they are in line with the manager. If the manager have some conflicts of interest with the company, then we want the directors to defend the company instead of defend the manager. Anti-takeover strategy. So if it's takeover strategy or takeover threat, then that could potentially mitigate agency problem because you basically put pressures on the managers that if the company do not do well, then it can be potentially being bought. And but anti-takeover basically will set up a protections for not being takeover. So that is instead of mitigating agency problem, that perhaps will protect or even add not against but for the manager's interest. So I think only number 1, A, is correct. Okay, moving down, what portfolio construction starts with selecting attractively priced securities? So when we talk about selecting securities, it's a bottom-up approach. So we look at specific securities. If we look at the allocation of investment portfolio across a broad asset classes, that is a top-down approach. So you determined at the top level how to allocate like 60-40, 70-30. So 60-40 is usually the allocation that people prefer. 60% equity, 40% bond. So that is top down. And then bottom up is exactly, an example is exactly like this. You want to select securities. So that is bottom up approach. 7, commodity and derivatives markets allow firms to adjust their management style. Not this is financial markets. It's not going to be related to management styles. B, focus on their main line of businesses and to their investment portfolios. I'm not sure. So it's not about specific businesses. So ways to doing business so that they will always have positive returns. Nobody can always have positive returns. We may expect positive return, but will not have positive return. That sort of determination is not possible because there is risk associated with return. So as long as there is risk, there is uncertainty. So we cannot say things for sure that you will have a positive return. Exposure to various business risks. Adjust their exposure to, yes, I think that is right. So I can give you an example. So let's say we have a manufacturing company and they need to purchase some raw materials, including some metals or like raw materials. And raw materials prices can be very fluctuate. For example, steel prices, the prices of steel, prices of gas. So therefore, if they want to lock in the price, basically they don't want themselves to expose to the volatility associated with the commodity price. Or, for example, this is an international company and they constantly need to have transactions between countries. So they are exposed themselves to exchange rate risk. So if exchange rate is extremely volatile, then there, it's something, it's financial risk, something that they can mitigate. It's not about, the two party of the transaction, buyer and seller, experiencing any operating difficulties. It's just the exchange rate. So there is a way to hedge the exchange rate risk away, which is using derivatives or commodity markets. So you basically can go ahead and sign or buy a futures contract to lock in the price for a certain period of time. Just pay your price for buying this contract. That's fine because you need to basically you dislike the volatility and risk exposure to exchange rate more. So you want to lock in the price. So in that case, the companies are able to utilize derivatives and commodity markets to adjust their exposure to various business risks. So move on. What portfolio management calls for holding diversify their portfolios without spending effort or resources attempting to improve investment performance through security analysis. I think when we talk about without spending effort, without spending resources, and just holding diversified portfolios, that will be a passive portfolio management strategy. Okay, go down. Financial markets allow for all but which one of the following? Shift consumption through time from higher income periods to lower. That is correct. Consumption timing. Price securities according to their riskiness. That is also correct. Channel funds from lenders of funds to borrowers of funds. That is also correct. Allowed most participants to routinely earn high returns with low risk. That is not accurate. All right, so we're choosing the one that is not correct here, I think. Yeah, so allow for all, but here's a but. So, but which one of the following? So financial market cannot guarantee return. So that is things that we always need to keep in mind, because those are risky assets. Unless we are talking about risk-free assets, that you have a low return. Risk-free return is usually low. Otherwise, all other returns, all other assets has risk. As long as they have risk, we're not able to guarantee any return out there. So you need to be aware, any investors need to be aware that the return, although we can expect that is certain range of the percentage, but as long as there is risk means that there could be some tail event, extreme event out there that may cause you to lose money. So therefore, we cannot say that financial market allows participants to routinely earn high return with low risk. If I cover with low risk, this sentence may be right, but you know, high return with low risk and routinely earn high returns with low risk is everyone's wish, but not all the people can achieve it unless you are very good managers, have skills or informations. But still, that is very, very hard. All right, so the success of common stock investment depends on the success of derivatives, fixed income, the firm and its real assets, government methods of allocating capital. So I think common stocks, another way of understanding common stock is it represents a common ownership. Well, represents an ownership. If you invest into the stocks, the common stocks, and become that means you become a shareholder. So become a shareholder basically means that you are one of the owner. So the success of a common stock means the success of the company, and that depends on the company itself and its real asset. So you will not see, and you'll never see that the derivatives fixed income drives up the performance of stocks. They are somewhere related to the performance of stocks, but they are not the reason. The underlying reason that could potentially drive up the performance of financial assets will be the company, will be the real assets. If the company does better and grow better and earn more in the future, then you will see the success and increase of the stocks. So then the government method of allocating capital is never directly related to the success of common stock investment. So it may be indirectly related. For example, government changes tax policy. Then that is usually a good news for corporations, but that is indirectly affecting the corporation's earnings. So it has the first order is still the company itself. Which of the following is not an example of an financial intermediary? Let's figure it out. Goldman Sachs, financial company, Allstate insurance company, First Interstate Bank, a bank. So IBM is just a company, so they are not financial firms. after much investigation, an investor finds that Intel stock is currently underpriced. This is an example of not security analysis. You're just looking at stocks. Well, not asset allocation because you're just looking at stocks. You're not looking at other asset class. It is security analysis because you're just you are trying to figure out whether this specific stocks is overpriced or underpriced. So B is correct. It is not top-down portfolio management approach because you're looking at a specific stocks. If you're looking at macroeconomic environment like Federal Reserve's monetary policy, the global supply chain issue, then that is the top-down approach. Passive management, it is not passive because passive means that you just buy and hold a diversified portfolio. When you're looking at a specific stocks, you already deviate from passive. You're actively looking at a security selection. 13, after considering current market condition, an investor decides to place 60% of her funds in equity and the rest in the bond. This is asset allocation. In a perfectly efficient market, the best investment strategy is probably passive strategy. Let me explain a little bit more here. So in a perfectly efficient market, this introduces an efficient market hypothesis here. So efficient market means that the price reflects all the information out there available to you, available to insiders, also available to all the market participants. So no one has better information, and no one can predict return in that sense, because basically the price should reflect information, and if all the people already know information, then no one has advantages. So in that case, we are not able to efficiently do an active strategy. Basically means that there's no arbitrage opportunities out there, or there is no undervalue, there is no overvalue. The prices of the stocks reflects its intrinsic value. So no under, no over. It's exactly its value. And there is no arbitrage opportunity because prices are efficient. So if it has a small arbitrage opportunity, it has been arbitraged away. So you cannot, when it's your turn to look at the stocks, it's gone. The opportunity is gone already. So active will not work if it's perfectly efficient. So market timing, I think it's this is a question for active versus passive. So it's too irrelevant to look at these two when you're talking about price and efficient market. So in an efficient market, asset allocation still works. Market timing may still also work. So we're talking about the best strategy out there. So it's the market timing. It's still a type of active strategy, and market timing. Okay, let me put it in this way. So if you adopt market timing strategy, that doesn't mean that you'll be successful. A lot of times, market timing is even harder than security selection. So that's why it cannot be the best. When most of the people who adopt market timing fail to really time the market, so that's not going to be a recommended strategy for most of the people. So even though there are rare cases where you have an investment genius that can really time the market, or perhaps just due to luck, people can time the market, but it's not going to be consistent. All right, so then the best, so therefore the best, and the best also, I think the implied understanding of best is that a possible, a doable strategy that can allow people to grow their wealth is passive. Market signals will help to allocate capital efficiently only if investors are acting on the basis of their individual hunches, as directed by financial expert, as dominant forces in the economy on accurate information. There are some obvious incorrect answers out there. Let me see. So market signal will help to allocate capital efficiently only if investors are acting. So not A, if every investor acting on their individual hunches, there will be a lot of behavioral biases or information processing capacity constrains people's understanding of the information when there is already a market signal. So not A. So as directed by financial expert, I'll leave it there. I'm not sure. As dominant forces in the economy, investors. So there are many forces in the economy, for example, corporations, for example, government, for example, households. We all need them to play a role. So it's not just investors. So they and investors are not playing the main role either. So I don't think C is accurate. Only if investors are adding on accurate information. I think this is better than B. So B is not necessarily wrong. But D, I think, includes B. If you add, because the information coming from financial experts is also good information. So I think B I think D includes some aspects that B touch on. So accurate information, including those that it is including some good advice coming from financial advisors, right? And also including other informations other than financial experts. So it's not just about listening to the advice of financial experts. There are many areas you don't. So you don't just need the advice from a financial expert. So for example, your personal consumption and etc. So you need to basically make the best decisions for yourself according to the information that you can get. Okay, 16, accounting scandals can often be attributed to the concept in the study of finance known as agency problem. So we talk about accounting scandals. Why would people have the incentive? Why would managers have the incentive to manipulate accounting numbers? The reason is maybe the firm is not doing well, and then they don't want people to look at them and put them into some people want to see who's responsible for this company's performance, and if the company does bad, we'll naturally see it as a failure of the manager. So therefore, manager, they do have incentive to manipulate accounting numbers and make it look better, or even do it in a illegal way. So manipulate the accounting numbers in some illegal way. So that is the agency problem. So the manager do not add to the best interest of the shareholders. So they are not maximizing shareholder values. So that is the agency problems out there. It's not securitization. It's not allocation of risk. It's nothing related to the risk and return trade-off. So accounting scandals is very specific. It's just specific to the points that the managers are not doing their jobs. Okay. So 17, the major cause of the mortgage market meltdown in 2007 and 8 was linked to private equity investment. I don't think this is something that we talk about in the class. Securitization is what we have covered. So mortgage has been securitized, and so mortgage pulled together and sold it to people. That is securitization. And too much of the securitizations basically creates excessive risk in the financial market. So in one of the one people on this chain could not pay off their debt, then it affects everybody. Everybody's financial asset, the value of everybody's financial assets. So that is the risk of securitization. Negative analyst recommendation, I think that is irrelevant. Online trading, I think that is also irrelevant. All right, so that will be it for the homework review, and look forward to seeing all of you in class.